California, the Golden State, sun, innovation, and a real estate market that, for decades, could only do one thing: go up. Every coastal agent had the same pitch. California is different. Demand never stops. You can't go wrong. This is not a cooling. This is not a soft landing. According to Zillow's Home Value Index tracking, over 100 million properties prices are projected to fall in 31 California cities simultaneously. Real estate analyst Wolf Richter stated plainly that demand has essentially collapsed. Home sales are running 41% below the pandemic peak. And only 15% of California households can afford to buy a median-priced home. Let me say that again. 15%. That is less than 1/3 of the 56% who could afford it in 2012. The California Association of Realtors confirmed this figure in August 2025 and called it near an all-time low. And the mechanism behind all of it, what we are calling the Golden State Spiral, is tightening in 10 cities right now at exactly the same time. We're counting down 10 California cities, worst to most catastrophic. You'll learn why insurance carriers are fleeing this state, what specific trap is killing deals in each market, and why city number 1, the name every broker in California is desperate to protect, will be the market you least expect. If you own property in California, or you're thinking about buying, this countdown is your balance sheet. Hit like, subscribe, and comment the California city you're in or almost bought into. On city number 10, Stockton. Trap. The super commuter anchor. You pull into Stockton, and the first thing you see is the traffic all pointed west toward the Bay Area. The pitch here was always simple: buy affordable, commute to the jobs, build equity as Bay Area overflow demand pushes prices north. Here is the trap nobody disclosed. The US Census Bureau identifies Stockton as one of the top 3 super commuter cities in America, 90 minutes or more each way, every day. Remote work softened that reality. Return to office mandates in 2025 just made it permanent. The demand premise that propped this market is gone. According to Norda Real Estate, Stockton's median sits at $420,000, down from $476,000 at peak, a real dollar loss of $56,000. At today's 6.37% rate, the monthly payment consumes 37% of median household income. Days on market, 40 days in 2025 versus 11 days in 2022, a 282% increase. Stockton broker said it plainly. Sellers bought a commute that nobody wants to pay for anymore. This is where the Golden State Spiral plants its first seed. When a market's demand was always commute dependent and the commute becomes unbearable, the floor vanishes. Stockton is the drive until you qualify dream that ran out of road. Are you in the Central Valley? Comment below. From here, we head south on Highway 99, and the next city shows a dimension of this collapse most analysts are ignoring entirely. On city number 9, Modesto. Trap, the wage scissors trap. Modesto was California's honest alternative, the place where a teacher or a nurse could still buy a house and get to work in under 30 minutes. The NAR praised it. Local agents called it the last affordable California. That label is now a historical artifact. Here is the structural reality. The California Legislative Analyst's Office confirms that housing payments on mid-tier Modesto homes rose 74% between 2020 and 2025. Wages grew 25%. That is not a gap. That is a scissors cutting through the buyer pool permanently. Redfin data. Days on market hit 30 days in Q1 2025 versus 8 days in 2022, a 275% increase. Price cuts visible on 31% of active listings. The median home in Modesto at approximately $455,000 to $468,000 requires a qualifying income of about $112,000. Stanislaus County's median household income, $81,468. The gap is $30,000 $532 a year. Teachers in Modesto city schools often earn in the $58,000 to $80,000 range. They cannot afford to live in the district they serve. When essential workers exit the geography, quality of life declines and property values follow. Exactly what the data shows happening now. Modesto is the last affordable California in the brochure and a hollowed out market in the data. Would you still buy here knowing this? Comment below. We keep driving south, and the next stop introduces the first insurance dimension of the Golden State Spiral. On city number 8, Fresno, trap, the fair plan blindside. For years, Fresno was the Central Valley's genuine opportunity, affordable, growing, university anchored. The NAR, which has a direct financial interest in telling you every market is fine because their members only get paid when deals close, was explicitly recommending Fresno as an undervalued buy as recently as 2023. Here is what they didn't mention. Fresno sits in a wildfire-adjacent corridor where private insurers have dramatically retreated. Since 2022, 7 of California's 12 largest insurance companies have limited or halted new policies statewide. Per the Independent Institute, buyers reaching the closing table in Fresno County are discovering for the first time that their only insurer is California's FAIR Plan, the state's insurer of last resort. That plan now covers 646,000 properties, per E&E News, nearly double 2 years ago. In Fresno's higher risk areas, homeowners are discovering that FAIR Plan coverage combined with supplemental policies can push annual insurance costs into the $4,000 to $8,000 range. That is up to $667 extra per month before the mortgage. CoreLogic identifies 1,258,748 California properties in wildfire distress zones. Days on market in Fresno, 42 days versus 14, 2022. Deal cancellations triggered at the insurance stage are now described by local agents as unprecedented. The spiral's second step, when properties become uninsurable, they become unfinanceable, and unfinanceable homes don't sell. Fresno is the Central Valley's affordability promise, with an uninsurability bomb underneath it. From here, we cross into Southern California and the data only gets darker. On city number 7, Riverside, trap, the seller denial lock. Riverside and the Inland Empire were the analyst favorites. LA access at Sacramento prices. Institutional money poured in. Builders over-delivered. The thesis was durable. The data says otherwise. Here is the number. Redfin data shows Riverside ranks first among the 50 largest U.S. metros in the seller-to-buyer imbalance, 61.3% more sellers than active buyers. And yet prices haven't cleared. Sellers anchored to 2021 peaks are refusing to accept reality. That refusal is freezing the market and compressing the exit window by the month. Atom data shows Riverside County residents spending 67.7% of average wages on housing versus the 28% maximum that defines sustainability. Active listings rose 2.7% year over year. Days on market, 55 days versus 24 inches, 2022. Price reductions on 28% of active listings. 1 in 4 sellers has already cut their price and still can't close. A former land acquisition VP at a top 5 national builder told us off the record, "We stopped underwriting here because exit comps can't support our entry prices." When smart money stops buying, retail buyers become the exit liquidity. Riverside is a pressure cooker with a stuck valve. What's scarier, a market where prices are falling or one where they're frozen and the pressure is building? Comment below. We head north toward Sacramento, and this is where the Golden State Spiral gets its name. City number 6, Sacramento, trap, the inventory flood. Sacramento was California's comeback story. Redfin named it a top domestic relocation destination 3 consecutive years. Bay Area refugees arrived with coastal equity, paying cash, lifting every comp. Agents said the demand couldn't stop, until it did. Zillow projects Sacramento at negative 2.5% through April 2026. The California Association of Realtors confirms active listings hit a 66-month high in 2025, the most unsold inventory since October 2019. The California Department of Finance confirms net domestic outmigration of over 89,000 residents in the year ending July 2025. The Sacramento Unsold Inventory Index is at 2 months. Days on market, 46 days versus 10 in 2022. When a market's entire demand thesis depends on refugees from collapsing coastal markets, and those coastal markets deteriorate, the refugees stop coming. This is the Golden State Spiral, officially named insurance exits, buyers retreat, inventory floods, prices fall, demand engine weakens, loop tightens. And here's the tease for city number 1. The trap we're building toward, the one we're calling the last exit illusion, begins in Sacramento. Every buyer who fled to Sacramento, Modesto, Fresno, or Riverside believed they found safety. They were wrong. We'll explain exactly why at the end of this countdown. If this investigation is giving you data your agent hasn't, subscribe and hit the notification bell now. We publish this kind of sourced city-level analysis every week. The viewers who see it first make better decisions. Because what comes next is where the Golden State Spiral fully closes. City number 5, Oakland. Trap. The vacancy spiral. Oakland was the Bay Area's scrappy underdog arts. Diversity, rising values at a fraction of San Francisco's price. Tech workers who couldn't afford the city crossed the bridge and bought in Rockridge and Temescal. The underdog bet felt smart. It isn't paying out. Downtown Oakland commercial vacancy has exceeded 32%, one of the worst urban core vacancy rates in any major American city. When storefronts go dark, foot traffic dies. When foot traffic dies, residents leave. When residents leave, the buyer pool shrinks. When the buyer pool shrinks, prices fall. The loop runs itself. Redfin shows Oakland with a 19.7% seller to buyer imbalance, 4th worst in California's major metros. Neighborhood prices are down 7 to 12% from 2022 peaks. Days on market, 15 days. The Bay Area was the only California region to post a year-over-year price decline in early 2025, per Managed Casa. Oakland is pulling that number lower. One East Oakland landlord told local media, 2 years ago, I had a wait list. Right now, I have 3 vacant units and 2 tenants trying to break their lease. Oakland's school enrollment has declined 7 consecutive years. Oakland is a Michelin-starred restaurant in a building with the utilities cut off. Tell us in the comments, what do you think Oakland's recovery looks like? Or does it? From here, we enter the blast radius of the insurance crisis, and the damage gets worse. City number 4, San Bernardino. Trap. The underinsurance gap bomb. San Bernardino was California's overlooked bargain. Massive county, closed mountains, closed desert. A price that almost made sense. Developers loved the scale. They overbuilt. Now that inventory is competing with something they did not model, the insurance reconstruction gap. Here is the trap. Cotality's 2025 wildfire risk report flagged explicitly. Policies written in 2019 to 2020 set dwelling limits on pre-inflation construction costs. Rebuilding costs have exceeded policy coverage by 25% or more in many cases. The gap between what a policy pays and what a rebuild actually costs can exceed $250,000 on a single home. Over 452,000 California homes on the FAIR plan have this problem right now, and most of those homeowners don't know it. The January 2025 Los Angeles wildfires triggered a $1 billion statewide FAIR plan assessment passed directly to policyholders. Insurance premiums in wildfire-adjacent San Bernardino zip codes are running $11,400 a year. Atom identifies multiple San Bernardino County zip codes among the highest in the nation for simultaneous underwater mortgages and declining valuations. San Bernardino is a beautiful backdrop for a financial disaster in slow motion. Which is worse, a premium that triples overnight or a home price that drops 15%? The next city is where the insurance crisis converges with an exodus that has no precedent in modern California. City number 3, Los Angeles. Trap, the wildfire premium trap. Los Angeles was always the untouchable market. Too much demand, too little land, too much global capital. Prices might slow. They could never truly fall. That was the consensus as of January 2024. Then the wildfires came. January 2025. Estimated insured losses, at least $28 billion. Properties in Malibu and Pacific Palisades sold for half price. Buyers couldn't secure insurance. Banks couldn't fund the loans, half price. In Los Angeles, in 2025, 7 of California's 12 largest insurers have now limited or stopped writing new policies statewide since 2022. In the highest risk Los Angeles zones, 1 in 5 homes has lost private coverage since 2019. Realtor.com's December 2025 analysis. Los Angeles median prices declined year over year. Days on market, 70 days, the longest of any major California metro. California's net domestic outmigration hit 239,575 residents in 2024, with Los Angeles County leading the outflow. In 2025, California's population dropped by a net 9,500, the largest absolute decline of any U.S. state. For the 6th straight year, California ranked last on the U-Haul Growth Index. More than 200 major corporations have left the state since 2019. Tesla, Oracle, Palantir, Charles Schwab, their employees left with them. Los Angeles is the world's most expensive parking lot, iconic to look at, punishing to own. Most viewers guessing city number 1 right now are guessing Los Angeles. They're wrong. The next 2 stops will surprise you. City number 2, San Diego. Trap, the price cut avalanche. San Diego was the National Association of Realtors' chosen safe harbor military anchor. Biotech pipeline, coastal scarcity. Prices were high, but justified. The consensus as recently as 2023, San Diego has earned its price tag. The data just rewrote that consensus. According to Realtor.com's December 2025 housing analysis, San Diego posted a 7.7% year-over-year price decline, the second worst of any major metro in the entire United States. Only Austin fell harder. The NAR-approved safe harbor is the second hardest falling major housing market in America right now. Once sellers begin cutting, holdouts follow, and the price floor resets. That is the price cut avalanche, and it has already started. San Diego median in early 2025, upper 800s of thousands. Monthly payment at 6.8% with 10% down, $5,280. Minimum qualifying income, $211,000. San Diego Metro median household income, $104,321. The income gap is $105,000 per year, not a challenge. A structural impossibility for most of the population. Active listings up 5.5% year over year. California real estate agent Kara Amir told Fox 11 Los Angeles, the perfect storm of higher interest rates, inflation, higher insurance costs, and high condo fees buyers aren't able to buy, and prices drop as a result. San Diego is the golden ticket printed on flash paper. What stopped you from buying in San Diego? Comment below. Because city number 1 is the market everyone, including us at the start of this investigation, assumed was immune. It is not. City number 1, San Francisco. Trap, the last exit illusion. This is not just a city, it is a global brand. The market that produced more billionaires per square mile than anywhere on earth survived every correction and became the benchmark every other market compared itself against. Every city on this countdown was sold as the safe alternative to San Francisco. The one that was always different. It is, without question, the number 1 most disastrous housing market in California right now. According to Norada Real Estate, San Francisco is projected to decline -5% through April 2026, the steepest of any major California metro. Let me say that again, -5%. On a $1.3 million median home, that is $67,600 in household wealth evaporating in 12 months. New listings fell 17.2% year over year, the fastest collapse of any California metro per Redfin. When listings crater and prices are still falling simultaneously, that is not supply discipline. That is a market in disintegration. Redfin's analyst, demand has essentially collapsed. The California Affordability Index sits at 22%. Only 22% of households can afford the median priced home statewide. In San Francisco, where the median exceeds $1.25 million, that number drops to single digits. Over 200 companies have left California since 2019. Oracle, Palantir, Salesforce executives, Hewlett-Packard Enterprise, the corporations that created San Francisco's demand base are gone, and their payrolls left with them. Now here is the last exit illusion fully revealed. Every buyer priced out of San Francisco moved to Sacramento. Every buyer priced out of Sacramento moved to Modesto, Fresno, or Riverside. Each city felt like safety, downstream from the problem, not inside it. The illusion that a safe harbor existed somewhere further out. The reality, every city on this countdown ran on demand that originated in San Francisco's ability to create high-income jobs and push workers outward. As San Francisco loses its companies, loses its workers, and loses its economic gravity, every downstream market loses its demand engine at the same time. The exit they all ran to was San Francisco itself, and the exit is closing. Here's the Golden State Spiral, assembled at its origin point. Step 1. Insurance carriers' exit carrying costs spike. Properties become unfinanceable. Step 2. Buyers retreat, demand collapses. Step 3. Inventory floods. Sellers pile in as buyers disappear. Step 4. Prices fall. Equity erodes. Distress builds. Step 5. More owners sell into a falling market. The cycle accelerates. Step 6. The economic anchor, the high-income job base, atrophies as corporations exit, removing the demand that could have broken the loop. In San Francisco, every step is running simultaneously. The spiral has closed. San Francisco is not just a real estate story. It is the story of a decade of cheap money, manufactured aspiration, and prices that were always a function of the belief that they could never fall. That belief has been disproven. The fantasy is over. We started with the California dream. 10 cities later, the picture is unambiguous. Stockton, Modesto, Fresno, Riverside, Sacramento, Oakland, San Bernardino, Los Angeles, San Diego, and San Francisco, each is a different stage of the same mechanism. The Golden State Spiral. Insurance exits, demand collapses, inventory floods, prices fall, the economic anchor phrase. This is a warning. If you own property in any of these markets, the data says the most significant moves are still ahead. If you have been watching from the sidelines since 2021 and something felt wrong, you were right. The Golden State Spiral has started. Nobody knows where it stops. If this gave you what your agent hasn't hit like, and share this with someone about to make a decision that could cost them 6 figures. Subscribe, because next week we are inside these specific zip codes where institutional capital is making its exit right now. The viewers who see it first make better decisions. Everyone else finds out 6 months too late.